Hi, my name is Michael Joyce from Agili, and I'm pleased to share with you our thoughts and viewpoints for the summer of 2018. President Harry Truman once famously said, "Give me a one-handed economist," because every economist that I know is saying on the one hand this and on the other hand this. So you're going to hear from me today a lot of on the one hand this and on the other hand this. And it's going to relate to what's been happening a lot over the past couple months. We've been hearing a lot about the trade war, tariffs, tweets, the whole 9 yards with that. And this is a very important thing. I talked about it in our quarterly commentary where I likened it to the Star Wars movie Phantom Menace, and I talked about the evil trade federation trying to get tribute from the planet Naboo. And this is really the same concept in real life. I mean, in essence, tariffs are taxes. And when you place tariffs, that's going to raise costs. And if you're running a company, if you have increased costs, you could eat some of those costs for a while, but you're not going to make your shareholders very happy because that's going to increase your expenses, going to lower your profits, it's going to lower your share price. If you then pass on these additional costs to consumers, that's not a good thing either, because that's going to add up to higher inflation, which will beget higher interest rates. If we have higher interest rates, that's going to mean lower stock prices. It's not going to be good for long-term bonds. It's not going to be good for real estate. So at this point, some of the trade tariffs have been implemented, some have not, but it's already had an impact on the world economy. Now, on the other hand, what we know is the economy, and not just in the United States, but the global economies continue to accelerate. We're seeing expansions in the gross domestic product, and things are pretty good. You know, unemployment is very low, there are wage gains that are going on, and this is being reflected in companies. They're seeing higher cash flows, and then higher cash flows can lead to higher stock prices. And valuations, which were pretty high at the beginning of the year, the U.S. stock market at the beginning of the year was trading at about 18.5 times forward earnings, is more reasonable now. Still a little bit higher than historical norms, but it is more reasonable at this point in time. So if this trend continues, will it offset the potential negative impacts of the trade wars? That's something that we're keeping a close eye on at this point in time. And speaking of valuations, it doesn't mean that all valuations are reasonable in the U.S. stock market right now. You know, there are some companies, particularly some of the large technology companies, that have gone up tremendously. And while they're great companies, they have great long-term franchises, they've probably gotten a little bit ahead of their fundamentals. So what we're doing with a lot of those companies or other companies that may have gotten ahead of their fundamentals is we're pruning some of those positions, taking some of those profits off the table. On the other hand, there's good dividend-paying companies, and what I'm talking about here are companies that have paid dividends for decades without fail, through good times and bad, that have not done as well this year, and that has created an opportunity. So we're looking at good entry points in some cases in some of these good dividend-paying stocks. Another area that hasn't done as well this year, in fact has slightly negative returns, are the international markets, which did tremendous last year but are down a little bit this year, mainly because the rise in the US dollar since the beginning of May. But this also creates an opportunity. You know, for those investors who are looking to rebalance their portfolio to get adequate positioning in international investments vis-a-vis US stocks, this is a good time to look at that. Another area that's experienced negative returns have been bonds. As interest rates go up, bond prices go down, and interest rates are up a little bit this year. Now, I'd hasten to add that our clients are mainly in short-term bonds, so we've experienced positive returns in the bond market this year. Last quarter, I talked about the new tax law that was passed right at the end of 2017. And if you haven't done so already, I would reiterate that you should get together with your financial strategist at Agili and look over your tax situation and look at ways to optimize it, because the new tax law is going to impact almost everybody. Now, some people are not going to fare quite as well as they did in past years under the old tax law, but for the most part, what we have found is that most people are going to pay a little bit less in taxes than they have before. So this would be a good time to kind of look at that and see if there's any position that needs to get done to optimize your situation. Now, as you may have heard right at the beginning of the video, I introduced myself as Michael Joyce from Agili. So our long-awaited brand refresh has occurred, and we are thrilled with it. We have now have a new website which is lit, and we're very thrilled with that. So if you haven't been to our new website, I would encourage you to do so. If you have any questions, please contact your financial strategist or visit agilipersonalcfo.com. Thanks a lot and have a great day.